purpose behind today's video is to have a global conversation about inflation. This conversation will allow us to deepen our understanding of inflation as it is actually occurring, and to understand the effect of rising inflation across different regions. Through comparison, we can come to a fuller understanding of the global picture. We can also explore the similarities and contrasts in the causes and effects of accelerating inflation across different political and economic contexts using the examples of Europe, the United States, and Australia. This conversation will also allow us to explore the ways in which our regional contexts are increasingly interdependent. In a globalizing economy, staying alert to the international context can better alert us to trends on the horizon and prepare us for opportunities and threats that arise during periods of economic volatility. Broadly put, inflation refers to the process whereby a general increase in prices develops through a discrepancy between the aggregate supply and the aggregate demand of goods and services within an economy. This discrepancy generates a ripple effect throughout the supply chain, and rising prices inflate the cost of production for businesses and the cost of living for households. Once started, the process is mutually reinforcing and very hard to stop. Too often, the only way out of inflation is a recession. Inflation can come in a variety of forms. Its current iteration is perhaps best described as sectoral inflation. So why is it best described this way? In this case, we need to look to the drivers of inflation. The initial causes of surging prices in most major economies was a discrepancy between the supply and demand for specific material goods. In other historical moments, we have seen inflation caused by excess demand or inflated wages, or isolated to one or two particular regions. However, in this case, price increases are being driven by a global shortage of material goods, which is compounded by increased demand in the wake of a global pandemic. Importantly, price rises are concentrated in key sectors of the economy, namely energy and to a lesser extent food. These goods are essential, which deepens the social and economic consequences of surging prices. In this sense, we get an idea of the global nature of our current moment. The trend in most major economies is broadly similar and deeply interrelated. Following a once-in-a-generation pandemic that shocked the global economy, the aggregate global supply of essential goods has struggled to keep pace with a sharp recovery in global demand. But this is only part of the story. To better understand the global picture, we need to explore some regional insights. As we delve deeper, we find that the dynamics of inflation differ across different regions. So too do the social and political effects. So we should look to these different contexts, starting with the primary causes of inflation in each region beyond the global trend.
If we take a look at Europe, as inflation started to gather pace towards the end of 2021, the European Central Bank initially described the price rises as transitory and mainly caused by supply bottlenecks in the aftermath of coronavirus lockdowns. A reorientation of supply chains had been expected to gradually bring inflation back towards target. However, inflationary pressures have continued to mount at a pretty alarming rate in 2022, as already stretched supply chains have been hit with a further series of price shocks stemming from Russia's invasion of Ukraine. That brings us to the situation that we see across Europe today, with inflation currently averaging 10.9% in the EU, which is higher than anything the trade bloc's seen before, and more than double the peak rate of inflation recorded during the global financial crisis. As we can see in the graph, soaring energy prices is the main driver of inflation across Europe. Behind the recent surge in energy prices is Europe's long-standing reliance on Russian fossil fuels, with imports from Russia typically accounting for around 40% of EU gas consumption, as well as similarly high shares of oil and coal imports. This dependence has created a perfect storm for price increases, with sanctions placed on Russian imports leading to increased demand for alternative sources of energy, and speculation regarding the security of Russian gas supplies into Europe, leading to a scramble to fill gas storage ahead of the winter months. These factors have caused European wholesale energy prices to spiral, with gas prices in particular far exceeding previous record highs, which contributed to a spike in the cost of heating and electricity generation, having knock-on effects throughout the energy value chain, and contributing to a 7% increase in European households' average cost of living this year. Rising food prices have also emerged as a major contributor to Europe's soaring rate of inflation, as the war in Ukraine has disrupted supplies of key agricultural commodities, mainly wheat and maize, for which Russia and Ukraine account for a major share of global exports. As can be expected, increased raw material prices throughout the energy and food supply chain have been passed on to consumers in the form of higher household bills and rising costs in supermarkets. These trends are particularly concerning as Europe approaches winter. However, if price increases remain concentrated in these goods, the situation will become increasingly manageable as long as supply bottlenecks can be resolved or demand is rationalised in a targeted fashion.
Inflation in the United States exhibits broadly similar dynamics to most other major economies. However, price increases in the US have been more gradual compared with Europe. Although the inflation rate has risen steadily, it is spread across a broader range of goods and services. Specifically, inflation has increasingly been driven by services and rent rather than just goods that have been affected by supply shortages. In many respects, the United States represents a more advanced stage of inflation as it is spread beyond supply chain bottlenecks and into the wider economy. In 2022, both the Consumer Price Index and the Producer Price Index have risen sharply. In fact, core inflation, which excludes food and energy, has risen to its highest point in almost 4 decades. Inflationary pressure on businesses and households emerged earlier in the US than in most other major economies. In the wake of the COVID-19 shock to aggregate demand, a combination of high levels of fiscal spending, low interest rates, and supply chain disruptions drove up prices in 2021. This trend has continued in 2022, although the rate of increase has slowed in recent months. In September 2022, inflation, including food and energy, increased slightly, driven by increases in the shelter, food, and medical care indexes. Specifically, the food index continued to increase, rising 0.8% in September. However, inflation growth was minimized by a 4.9% decrease in the gasoline index and an overall decrease in the energy index. Although the energy index decreased 2.1% over the month, the producer price index increased slightly in September, following 2 months of slight easing, as prices for final demand services rose. The inflation rate, not including food and energy, also continued to rise slightly in September. This increase was largely driven by a rise in indexes for shelter, medical care, motor vehicle insurance, new vehicles, household furnishings, and education. Conversely, the indexes for used cars and trucks, apparel, and communication experienced declines during September. Furthermore, wages in the United States have increased during 2022 as a result of the tight labor market. This has furthered concern from the Federal Reserve that inflation is entrenched in the U.S. economy. Although the increasing rate of inflation has slowed, it remains above market expectations, signaling that inflationary pressures remain high. As price increases in the U.S. are increasingly driven by rent, services, and wages, the rising fear that inflation is becoming increasingly entrenched in the U.S. economy are well placed. Yet there are also signs that the supply chain bottlenecks are easing, and the prices of material goods are starting to slow. If this trend continues, inflationary pressure on U.S. households and businesses may start to ease.
I would argue that the situation in Australia is probably more ambivalent and more mixed. Like Europe and the United States, we had a decade of relative price stability, followed by a sharp increase in 2022. But the drivers of this inflation are isolated to material goods, mostly imported goods. So this really shows the importance of global supply chains as a driver of inflation. However, contrasting the situation in Australia with the United States is that wages and services are still very much trailing the rate of inflation. So inflation is being driven by shortages, supply shortages, discrepancies between the supply and demand for material goods, particularly energy, food, and increasingly things like furniture and these types of things. The economic effect of this situation is hard to pin down. For inflated commodity prices have been very beneficial to many Australian industries. Australians are a net exporter of energy, and so exporters of primary goods have very much benefited from the situation. So this is a mixed kind of dynamic. Businesses are also suffering, and households are suffering, though, from the rising cost of living and the rising cost of production. So it's hard to pin down particularly what the situation is in Australia, and it's somewhat mixed between the European and the US situation. We have inflation is isolated, but it's not moving as fast as in Europe, but it's definitely not as broadly based as in the United States. So exploring the varied dynamic across Australia, Europe, and the United States also shows us the perilous position that policymakers are finding themselves in. Locating a balance between easing inflation and avoiding recession is a very difficult task. Yet in many respects, the response to inflation, more than inflation itself, that presents severe and oftentimes unforeseen economic and political challenges. We should look now to the differing ways in which governments and central banks have responded to rising inflation and the potential implications of this response.
Following unprecedented fiscal spending during the pandemic, governments and central banks around the world are implementing a tightening of monetary policy in response to surging inflation. These monetary policy shifts are largely being led by the Federal Reserve. To spur economic activity during the height of COVID-19, the Fed dropped interest rates to record lows. However, as inflation has surged, the Fed has reversed the trend of low interest rates with a series of aggressive hikes in an attempt to ease inflationary pressure on businesses and households. In September 2022, the Fed raised the interest rate benchmark by 75 basis points for the third consecutive meeting. More increases are widely expected as the Fed has declared their intention to lift the benchmark interest rate to 4.5% by March 2023. This significant shift represents the sharpest rise in interest rates since the early 1980s, following over a decade of record low interest rates. The tightening monetary policy carries mixed implications for the U.S. economy. On one hand, the cost of borrowing has increased, which is likely to limit growth and potentially increase the unemployment rate. Additionally, as lending has become increasingly attractive in the U.S., demand for U.S. government bonds will also increase, which has caused a surge in the U.S. 10-year Treasury yield. As a result, the value of the U.S. dollar has increased significantly, reaching its highest point since 2002. Overall, these intersecting developments have varied economic effects on U.S. businesses and households. Inflationary pressure on businesses and households have eased to some extent as price increases for essential goods, specifically energy, have begun to slow. Additionally, the surging U.S. dollar is likely to ease inflationary pressure on imported goods as a result of increased purchasing power of the U.S. dollar. Conversely, industries that typically benefit from inflationary conditions are likely to be pressured by the increasing value of the U.S. dollar, since this makes U.S. exports less attractive on the global market. Furthermore, commodity prices are typically negatively correlated with the U.S. dollar and the 10-year Treasury yield. As a result, commodity prices have taken a hit, which has reduced the profitability of several key exporters. For example, many U.S. firms profit heavily from overseas sales, which means a sharp rise in the U.S. dollar directly undermines profitability for many major U.S. firms. Overall, efforts to slow inflation have increased the likelihood of recession, as U.S. authorities have grown concerned over the prospect that inflation is becoming built into the U.S. economy. Aggressive hikes in interest rates, coupled with a surge in the U.S. dollar, indicate the heightened risk of inducing a recession that are inherent in the fight against inflation. It is possible that these efforts will provoke unintended consequences that pose a much deeper threat to the performance of U.S. industries. As inflation spreads, the instruments available to policymakers are increasingly blunt. Fiscal and monetary tightening in the United States carries severe implications, not only for the U.S. economy, but for the global economy as a whole. The surge in the value of the U.S. dollar is a window into some of the many economic side effects of the fight against inflation.
In terms of Europe's policy response to rising inflation, the European Central Bank has so far trailed the Federal Reserve in raising interest rates. In July, it announced its first increase in rates in 11 years, raising rates by half a point. The ECB then raised rates by a record margin of 75 basis points in September, with a further increase of 75 basis points in October 2022, bringing the cumulative increase from the last 3 meetings to 2%. The bank has also confirmed that further hikes are likely in the short term, though the size of these subsequent moves remains dependent on the path of inflation. This tightening of monetary policy following years of record low interest rates represents an aggressive strategy. However, given that the current surge in inflation across Europe is attributable to rising costs as opposed to an overheating of the economy, these measures alone are unlikely to be sufficient to stem the rise in prices. Instead, a more targeted support is required, particularly focusing on limiting the effect of rising wholesale energy prices on consumers, as well as tackling the cause of energy price rises by reducing the current disparity between energy supply and demand. Within the trade bloc, policy responses differ between member nations, but the main focus of support is pretty universally concentrated around limiting energy inflation. As seen in the graph, Germany's inflation rate crept above the EU average in September 2022. The EU's largest economy is particularly reliant on Russian gas, which accounted for around 65% of all German gas imports in 2020. The end of temporary support measures and an uplift in energy inflation caused price increases in Germany to gather pace during the month, with the government responding by announcing plans for a €200 billion cap on gas prices. Belgium has also recorded particularly high rates of inflation, which may force the government to reconsider mandatory inflation-linked wage hikes in the near future. In contrast, the rate of inflation in France has remained below the EU average in recent months, with policy measures including fully nationalising energy provider EDF and forcing the company to limit electricity wholesale price increases. However, such universal support packages come at a significant cost to the governments already burdened with high levels of debt following the coronavirus pandemic. It's clear that with inflation concentrated in particular goods, a combination of monetary and fiscal measures will be required to tackle inflationary pressures. As the French example shows, these can include a range of measures that are aimed directly at easing the price of energy. But whatever the policy instrument, keeping inflation contained within particular sectors reduces the threat of recession.
So the policy situation in Australia is somewhat more muted. So in a broad sense, the fiscal and monetary tightening that we've seen all over the world is also being seen in Australia. A decade of record low interest rates has been followed by aggressive hiking in 2022. Fiscal spending, record levels of fiscal spending during the pandemic has been reined in. And the government is, very reticent to add any demand through extra fiscal spending. Very much mirrored in many other situations around the world. However, we can also see a bit more caution being taken with regards to the lifting of interest rates. The Reserve Bank, Australia's central bank, was much slower to lift the interest rate, and they've slowed their lifting of the interest rate in recent meetings. Australia, the reasons for this is that Australia has high levels of private debt. So this makes, especially with regards to mortgages. And so this makes the lifting of interest rates a much more fraught exercise, politically and socially and economically. So the Australian policymakers are trying to approach this situation with more caution, but they also have a bit more leeway because, as in Europe, inflation is still very much contained within material goods. Services and wages aren't driving inflation, they're very much trailing inflation. So Australian policymakers aren't left to resort to seeking to lower aggregate demand, which is most likely going to induce a recession. But that's the situation at the moment. Things are moving quickly and they could change. But looking at this situation, Australia is in somewhat of an enviable position compared with the United States and Europe. We don't have a soaring energy crisis, and inflation is more contained. So shifting focus I think we should look to the trends on the horizon. We should speculate maybe on the likelihood of a recession and maybe look for some signs of life with regards to prices easing and what are the prospects for the short and medium term.
The most pressing concern on the horizon are the economic, social, and political implications of the energy crisis. The IMF expects large parts of Europe, including Germany and Italy, to fall into technical recession in the near term. And although the euro area is actually expected to avoid recession, the risk posed by further disruption to energy supplies over the winter months could worsen the economic outlook. In terms of inflation, policymakers will be encouraged by early expectations of a gradual decline in energy prices from the second quarter of 2023, while the lifting of blockades in the Black Sea has supported a renewed rise in Ukrainian grain exports, which should alleviate food supply shortages in the medium term. However, the outlook for inflation remains contingent on developments in the Russia-Ukraine conflict, which is likely to remain volatile at least into 2023. One thing that is certain is that countries across Europe will continue to face difficulties through the winter months. Increased demand for electricity and gas during this period, as well as a time lag between changes in raw material prices and when they're reflected in household finances, means that inflationary pressures are likely to continue to intensify in the short term. Beyond this, in the absence of any further significant price shocks, attention is likely to turn to restoring economic growth in the medium term. The competing demands posed by the need to limit the short-term impact of rising prices and ensuring that the policy environment doesn't restrict growth prospects in the medium term presents a particular challenge for EU policymakers. So while the headline figures and outlook for the winter in Europe is daunting, price increases remain relatively contained, and if supply issues are resolved, the situation becomes increasingly manageable. Resolving the energy crisis is thus an imperative, both to ease inflation and to reduce the wider economic damage that efforts to curb inflation can produce.
The inflation rate in the US has slowed for the third consecutive month in September of 2022, showing the lowest rate in 7 months. Despite the slowdown, the inflation rate remains above previous market forecasts, signaling that inflationary pressures remain elevated. The US industry has slightly benefited from declining prices of key material goods, particularly energy. In September 2022, the energy index decreased 2.1%, which was primarily driven by a 4.9% decrease in the gasoline index and a 4.7% decrease in energy commodities. Conversely, energy services increased 1.1% over the month, with the natural gas and electricity indexes both increasing. Although slowing energy prices have somewhat eased cost pressures on businesses, the producer price index for final demand increased 0.4% in September, following 2 months of slight decreases. The increase is largely due to a rise in prices for final demand services. As energy prices ease slightly, consumer price inflation is increasingly driven by wages, rents, and services. In September 2022, the index for services increased 0.8%, with shelter, transportation, and medical care services all increasing. However, these segments are growing at a slower rate than the initial drivers of inflation, which were caused by supply shortages. This furthers the concern that inflation is more ingrained in the United States economy rather than being solely a consequence of supply chain disruptions. Although some price increases have slowed month to month, the year-over-year price changes for all categories remain extremely elevated. Additionally, changes from month to month have been varied, highlighting that trends frequently shift. This also increases the likelihood that the Federal Reserve will continue to pursue interest rate rises as it fears that inflation is more entrenched in the U.S. economy. These trends heighten the prospect of a recession, which may have a series of unforeseen consequences that present a deeper threat to businesses and households. Delving beyond the headline figures, there are signs that price increases caused by supply chain disruptions can ease over time. However, as inflation in the United States has become broad-based, the likelihood of a recession has quickly increased, particularly as the Federal Reserve remains determined to pursue an aggressive tightening of monetary policy.
So I think the situation in Australia is somewhat similar. I mean, if we delve beyond the headline figures of inflation, we can see some signs of prices easing. Producer prices are starting to ease, energy prices are starting to ease, and we can start to see through the example of the United States that supply chain bottlenecks can or are easing around the world, and this will relieve prices. And so that's a real positive sign for the Australian economy, because at the moment, price increases are really concentrated in imported goods. So that's a real sign of positivity for the Australian economy, and may enable Australia to avoid a recession. But the in the short term, interest rates are still likely to rise as policymakers remain determined to keep a lid on inflation, stop it from spreading beyond material goods as it has in the United States. Another key factor to keep an eye on is the likelihood of a global recession. Australia's situation is very much contingent on the global economy, and as a key exporter of energy and minerals, we really rely on demand from the global economy. And so, with a coordinated tightening of fiscal and monetary conditions that we're seeing all over the world in most economies, this really heightens the risk of a recession. So this is something to keep an eye on from an Australian perspective, and very much dependent on what happens in the United States and Europe. So to conclude, I think this was a brief exploration of the complicated nature of the inflation as it currently stands, but we really get an idea of how global this story is. We have a sort of the understanding the global trends don't really give us the full picture. And you look to Europe with the a food and energy price shock that has deep social consequences, but it's still largely contained. Then you have the United States, where inflation is more broad-based, spread beyond supply bottlenecks, and these produce different responses. But in the end, it's all deeply interrelated. And so we really need to stay alert to these shifting dynamics at a global level. Understanding what's happening in the economy is crucial to formulating business strategy. But as the economy becomes more interdependent, we need to start to develop global perspectives, and having a more balanced view of the economy and getting regionally specific insights can help us sort of develop this picture.